All right, welcome back to Yahoo Finance Live on this Tuesday morning. Beautifully timed note here from the folks over at Goldman Sachs talking about the trade on financials. Nice factor rotation underway today. Energy and financials. Well, all we've talked about on the show so far, how great energy stocks are. Love financials, two lagging sectors in the S&P this morning.
Yeah, right, Miles. Perfectly well timed. After a vacation, everybody's looking for content. And here's Goldman coming out saying with a pretty big call, I would say, buy the banks or some of the banks. So Goldman Sachs, Richard Ramsden out this morning with a good note looking at why he is bullish on a lot of the banks. And I'll take through a couple of reasons here. Really, improving economy equals higher rates, and that is good for bank profits. Bank stock valuations are cheap compared to the S&P 500. Ramsden knowing the average PE ratio on bank stocks forward, that is 12.5 times compared to the S&P 500's forward PE, pushing about 22 times there. So a wide disparity there. Kind of shocking in many respects. But also banks are making it rain in terms of capital returns. Look what we saw a couple weeks ago. The banks all passed the Fed stress test. You had the likes of Morgan Stanley coming out, raising their dividends significantly, coming back with big stock buyback plans. That is a good thing to see from the banks. It is likely to continue moving forward. But to your point, Miles, financials, they've really lagged and really across the board. Going down the list here, Citigroup stock is the worst performing bank stock over the past month, according to Yahoo Finance Plus data, down 11.5%. JP Morgan down 6.5%. The KBW Bank ETF down 6.5%. Really, the best performing bank stock on a relative basis is, in fact, Morgan Stanley, because, as I mentioned, they came out with a strong dividend raise, strong buyback plan a couple weeks ago after passing the Fed stress test. You're seeing the market embrace a stock like Morgan Stanley. But overall, here's my take, guys. You look at these dividend yields among some of the banks, and I just ticked through a couple here on my notepad. You have like JP Morgan dividend yield 2.3%, Bank of America 2%, Morgan Stanley dividend yield at 3%, some of the highest bank dividends from the bulge bracket firms in the financial industry. Yet you have their PE multiples trading well below the S&P 500. I look at JPM. Its PE multiple is 12.7 times, which interestingly, maybe this is for a different segment, is below Wells Fargo's PE of about 15 times, which is, to me, is very shocking given the ongoing struggles Wells Fargo is having trying to claw back from the account fraud scandal a couple years ago. Next up, as I just mentioned, the valuations on bank stocks just look silly cheap compared to the S&P 500. And then Fed as a friend to bank investors, Miles. And I have two charts here I'm sure you would dig. You know, historically, bank stocks will do well as rates start to rise. The basic premise there is as rates go up, banks could charge more on their loans and their net profits go up, valuations expand. And some of the charts we're seeing right now, Fed funds futures are expecting rate increases. There you go, to actually go up. And you can see the 10-year yield and the spreads within that yield likely to go up too as well and benefit the bank stock. So, you know, a pretty good call overall by Rams. And I will note he is not keen. He is not keen on Citigroup here. It's one of his least favorite bank stocks owned here. He is very keen on PNC in Morgan Stanley.
Isn't there a reason that bank stocks are trading at a discount to the S&P, Sozzi?
That is, yeah, they should not.
It's because they're worse businesses. That's why. It's because they're worse businesses than the overall market.
Well, historically, my sense has always been they have always traded at a discount to the S&P 500, but not to this extent. You know, Ramsden noting, you know, the historical discount to the S&P 500 is at an all-time high. And to your point, Miles, I think it doesn't make a lot of sense. I mean, they were buying back a lot of stock. They're raising their dividends. The U.S. economy is roaring back after the pandemic. Even if that growth decelerates in the back half of the year, the grounds are still set for a pretty good year or 2 years for bank profits. It's a mystery to me why this valuation exists and to the extent that it does.
Well, but I mean, financials have been dogs for the last decade for a variety of reasons, and I think that they've had some visibility into a better economic cycle. You've had a 50% rally in regional banks over the last 9 months, a huge move for a stodgy sector, and now we're back to talking about the dividend yield and the sector trading at discount. Well, I mean, go look at the market today. We're back to FANG. We're back to growth. We're back to stuff that actually grows and is actually the future of the economy. We're off the financials and energy stuff. And I think it goes back to our conversation, last week about valuations. We could do the whole dance again about XXX looks expensive. Well, that's the stuff that goes up. The stuff that looks cheap is stuff that doesn't go up as much. Financials have looked cheap for a long time. Values looked cheap for a long time. And I know that everyone's all excited about value because it's had a really nice 9 months here. But there was a reason that it was trading at a discount. And there's a reason that it will trade at a discount in the future. So that's all.
Myles, sounds like you like AMC better than Wells Fargo, right?
Listen, you can do the obvious boring thing and just buy the whole market because stocks go up, right, Myles? So
go buy a CD.
I mean, if you don't need it tomorrow, if you don't need it till you retire and you're young enough, why bother trying to pick the dividend yields and who's going to win and who's not, and
sure,
keep it simple.